What's going on with FuboTV stock? The price has gotten absolutely hammered since 2021. Look at this chart here for FuboTV stock price. It exploded in the aftermath of the pandemic, shooting up all the way up over $60 per share, and then absolutely collapsing and trading at $1.02 per share as of this recording on March 20th, 9:30 a.m. here in the West Coast. So what's going on with Fubo TV? Why has the stock price been so hammered lately? I'm going to answer that question in this video by looking through Fubo TV's latest earnings call that management held with investors, and we're gonna gain some insights into what's going on with the company. I'm gonna explain the flawed business model and what's causing all of these losses, and hopefully by the end of this video you'll have a greater understanding of why Fubo's stock price is getting so hammered and why it's staying low and not recovering. All right, so let's get into the details. Here we have the CEO, David Gandler, talking to Wall Street analysts and describing, what happened in the company's latest quarter and the prospects, right? So this was on February 27, and the CEO starts off by saying, we closed our fiscal year with 1.45 million subscribers in North America, a 29% increase year over year, and 420,000 subscribers in the rest of the world streaming business, a 117% increase year over year. Now, this North American increase of 29% year over year, this is a significant slowdown from the rates of growth in 2020, 2021, of course, right? When we were locked up at home, we wanted to stream content, we wanted to sign up for content subscriptions, and Fubo TV was a prime beneficiary. Revenue and subscriber growth it eclipsed 100% and reached even 200% for several quarters for Fubo TV. That's been trending way downward, and Fubo TV is having a harder time attracting customers, and it's having to work harder to attract customers. Uh, so part of this change in Fubo TV's trajectory is a result of the change in the overall broader market, right? Ever since the Federal Reserve started increasing interest rates, investors have been less tolerant of unprofitable growth stocks. Fubo TV is a very unprofitable growth stock that is losing a lot of money on the bottom line. So, since the Federal Reserve began raising interest rates, the tolerance for investors has decreased, and so management, Fubo TV management, rightly observed this change in investor sentiment and started to talk about positive free cash flow and unit economics, right? Before that, they were not talking about those metrics. They were mostly focused on attracting subscribers and revenue growth. Those were the figures they were focused on. Now that the market sentiment has changed, management has rightly changed its focus on more effective, efficient growth. And so management is saying that they're expanding unit economics and they're planning to generate positive free cash flow in 2025. So, 2 years from now, they're planning to generate positive free cash flow. So, the proof will be in the pudding if they will actually achieve positive free cash flow. And I want to see how many subscribers and revenue decreases will need to be put in place in order to achieve that positive free cash flow. In other words, how much is the company gonna need to reduce their growth ambitions in order to become self-sustaining positive free cash flow? Right? I'm okay if it needs to decrease its subscriber growth and revenue growth to become positive free cash flow, right? If you've been following me and my investment style, I prefer sustainable growth. I prefer businesses that have a strong foundational business model, right, that can sustain themselves. So I prefer, grow slowly, but grow sustainably, right? Don't try and rush out of the gates and reach $1 billion in revenue when you're losing a ton of money on the bottom line. Take 5 years to reach $1 billion in revenue instead of just 1 year, if that means you're going to do that in a profitable manner, in a cash flow positive manner. So this remains to be seen how and if the company reaches this level. But the fact that management is focusing on uh, unit economics and cash flow is good news. So highlighting that their customers already spend over 100 hours on their platform every month on average. This isn't incredible. I would say, what is that? About 3 hours per day. Maybe one. That's like watching one sporting event live, right? One basketball game or one football game every day for a customer. That's about average. That's not uh, really great or really bad. So on the content front, it's becoming clear that we have more leverage than we expected due to certain content drops that historically have had almost no impact on subscriber growth and retention. This is key. So let me take a moment and break this down here. What the CEO is saying here is that they are able to drop content while at the same time not losing too many subscribers. Okay, so what that means is that they can lower the level of service they offer customers and still keep those customers and keep those customers paying the same price. Okay, so that's a key. They're attracting customers at a certain point, right? Saying, look, you get all this content when you come to Fubo TV, and then, oh, by the way, we're gonna reduce what we offer you slowly, but we're going to give you less and charge you the same over time, and that's going to help us with our profitability, with our cash flow. So the fact that they've begun doing this and haven't noticed much subscriber decreases is good news. Although if I look at the data and I look at Fubo's growth rates over the last year and a half or two, those are falling down substantially. So I don't know how much of that is due to Fubo removing content, and I don't know how much of that is due to the economic reopening and just the overall decrease in consumer demand for streaming content. So we'll begin to see more differentiation between those two factors as time goes on. And investors in Fubo TV stock should hope that the decrease in subscriber growth is only due to the fact that economic reopening has gained momentum and overall demand is decreasing. So I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Because they plan to selectively carry content that will drive subscribers and leverage our increased scale. In other words, they're going to pick and choose now of which kind of content to offer, and they're going to start to offer customers less and less content while charging them the same or even more. All right, that's how they plan to incrementally achieve profitability, right? Start customers off with this big selection and get them to sign up because they get all of this, and then every month or every quarter maybe chop off a little bit of content, chop off a little more, chop off a little more, and hope that customers don't notice that they're getting less and less service while paying the same or even increasing prices. So they plan to drive leverage on subscriber related expense line year over year basis going forward. This is something they haven't been able to do. If you look at Fubo TV's presentations, they have this infographic that shows their overall cost structure, and 95% of their total costs are subscriber related costs. So with each new customer, they're having to pay an increase fee to carry that content, to show that content to their customers. So overall, this has been the thing that has held Fubo TV stock down. This has been why FuboTV stock has collapsed and stayed low is because the business has not scaled, right? It hasn't shown efficiencies in scale where they've added all of these customers, all of this revenue, and they're still losing a ton of money on the bottom line, and they're still paying 95% of their overall expenses to subscriber related expenses. So they haven't demonstrated that by having more subscribers, they can lower their subscriber related expenses. They haven't demonstrated that. And that's what's frustrated Wall Street, and that's what's frustrated everyday investors like you and me, is because they're paying too much for the content, right? They're they're paying a certain price for this content, and they're bringing it and selling it to consumers, to viewers. But the problem is that they're paying too much for the content and not charging consumers enough for the rights to view that content. And there's a mismatch there, and Fubo TV is only incrementally trying to close that gap, right? By saying we're slowly going to reduce the amount of content we pay for, and we're slowly going to raise prices on our customers. And they're hoping that by incrementally doing this, that customers don't notice and they don't cancel and they don't switch over to another provider and they stick with Fubo TV. So that's what hasn't happened yet. The proof of the sustainability of this business in the long run hasn't been shown to investors yet. So they recently increased prices of their US based plan by $5. That's good news. And in another piece of good news, YouTube TV also said they're raising prices. So that's good news for the industry overall, that price increases are going into effect. So following those moves in Q1, meaning the reduction in content and the increase in prices, they're very pleased with the early retention metrics and they're monitoring closely. So they're happy with how many people are sticking with Fubo TV even after they raised prices and reduced content, right? They're hoping that enough consumers don't notice and they stick with Fubo TV and keep paying these higher prices for less content. So because all right, and I will end with these two final statements from the CEO here. Another strategy they're implementing is creating these free channels, these fast they're called, so free ad supported channels, and they have 80 of these channels now where they're totally free and ad supported, and they generated 5% of their total ad revenue in 2021. This was up from just 1%, I'm sorry, 2022, and that was up from 1% in 2021. So 5x increase in the percentage of ad revenue that's coming from these free channels. Although ad revenue is still a relatively small portion of Fubo TV's overall revenue, but it's nice to see that they have this rapidly growing segment evolving within the company. In another note of good news, their largest advertisers from 2021 increased their total spending in 2022 by 85%. That's good news, right? Because they're seeing a good return on investment, so they're increasing their investment. Although, again, I will point out advertising is still a relatively small, I would say about roughly 10% of Fubo's overall revenue. All right, so that's all I've got for this video. I hope that sheds some insight into what's going on with Fubo TV, why the stock price is down so much, and why it's having a hard time recovering. All right, the big takeaway from this is that Fubo TV is paying too much for content and charging too little for it. And it's afraid that if it increases prices enough to put the business on a sustainable level, that there will be a mass customer exodus. So it's not doing that quickly. It's doing that very slowly, raising prices a little bit, reducing content a little bit. But the problem is that the company's losing a lot of money on the bottom line. They only have enough cash. If they keep at this pace, they only have enough cash for about 12 months if they keep losing money at the rate they've been losing money. So they're moving incrementally, but their business, the business doesn't have that much time to be moving incrementally. It's just a very scary situation, I would say, if you're an investor in FuboTV, because you don't know if this company can sustain itself. You don't know if it's viable, if it's sustainable, right? The very core essence of the business is uncertain. And that's a big question mark. And so you can understand why the stock is down so much, because it's like, can this business survive on its own without raising capital from investors and borrowing money, selling stock, borrowing money, selling stock, and keep losing money on the bottom line? And I don't know. It certainly it has not proven that it can. It's moving on the right track. It's making the moves necessary by raising prices, reducing content, but it remains to be seen if customers will stick around, if they'll pay the higher prices for less content. All right. So as always, thank you so much for watching. I'm adding a few videos right now that are popping up on your screen. I think you'll enjoy those. So click on one of those and I'll see you over there. Thank you so much for watching.